Welcome to our program on the Hong Kong national security law and the future of the financial markets. This is the second of 5 programs in our Seeking Truth Through Facts U.S.-China program series. We are thrilled to have MSCI Chair and CEO Henry Fernandez as our special guest speaker. He is joining us from New York. In our audience, we have over 330 people signed up, including our Chair Emeritus Chung Moon Lee, our Honorary Chair Jack Wadsworth, and our Chair Ken Wilcox. We have at least 10 global trustees with us and 15 of our Northern California board members, as well as colleagues joining us from Hong Kong and our headquarters in New York. Thank you and welcome to all of our sponsors for this U.S.-China program series as well. I'm Margaret Conley, the Executive Director of our Northern California Center. Our format today, I'm going to introduce Andy Rothman. He is going to introduce our speaker, Henry Fernandez, and then he'll lead a fireside discussion with him. Andy's going to take questions from the audience using that Q&A box at the bottom of your screen. So please keep those questions coming. We do want to make this as interactive as possible. This is being recorded and it is on the record. Speaker bios are on our website and they're also in the chat box at the bottom of your screen. A few words about our moderator, Andy Rothman, who is our board member as well. He's an investment strategist at Matthews Asia, developing research on China's economy and political evolution. He writes a regular publication, Sinology, on all things China. His recent publications are on China trends and COVID recovery. Andy lived in China for 20 years and also spent 17 years in the Foreign Service. When I was a foreign correspondent in Shanghai at Bloomberg, I would call Andy for the latest data and for help putting everything in historical context. Andy, we are so grateful that you could be here to do this for us, and passing it off to you.
Thanks, Margaret, and thanks for organizing this. And mostly I want to thank Henry Fernandez for making time to join us today. We really appreciate that. Henry is the chairman and CEO of MSCI and has led the firm for 25 years. MSCI is one of the world's leading provider of indices, portfolio construction and risk management tools for investors, including us at Matthews Asia. And they also are a major provider of data on environmental, social, and governance, ESG, issues for investors. MSCI's clients are the world's investors, including mutual funds, pension funds, and sovereign wealth funds. MSCI itself is an S&P 500 company listed on the New York Stock Exchange. Before joining MSCI, Henry worked at Morgan Stanley. That's the MS in MSCI. And in the late 1970s, he was a diplomat at the Nicaraguan embassy in Washington. Henry now lives in New York, and he's joining us from there. Welcome, Henry.
Thank you for having me.
I'm looking forward to the conversation. Thank you. Now, I'm sure everybody in the audience is familiar with the MSCI indexes. They're in the news constantly, but I think many might not be all that familiar with how significant a role indexes play in global capital markets today. So let me give you an interesting statistic. Over 12 trillion US dollars in assets is benchmarked against MSCI's public markets indexes, $12 trillion. And I also think many of us are not really sure how MSCI puts these indexes together. So Henry, can you give us a brief description of the process? Maybe use China as an example. In 2017, MSCI decided to gradually include China A shares into your emerging markets indexes, which are tracked by funds worth about $2 trillion. Then last year, MSCI announced plans to quadruple the weight of A shares to 20%, which is going, I think, to lead to significant investment flows into the Chinese market. What were the key factors that led MSCI to include A shares, Henry?
Thank you, Andy. Starting with your first question on the indices and the role of indices in the investment process, you could think of indices being used in 3 broad categories by global investors. The first one is to benchmark the performance of their portfolios. And in that capacity, indices are, think of them as representations of markets. So aggregations of markets or exposure to a particular market. In the second use case, indices are replicated instead of simply being a guide or a benchmark, they are fully replicated by the investor, and that is typically known as indexed investing or passive investing. Many exchange-traded funds in the world, for example, are all indexed investing vehicles in the equity and fixed income markets. The third category is that indices are used for exposure management and hedging management and risk management. So indices are used, therefore, for listed futures, listed options, and structured products around the world. So those are the broad categories, and these indices have become even more important in the investment process because the global investing industry has become more complex, more diverse, quite a large number of securities in the world, as opposed to maybe 30, 40, 50 years ago, in which the number of investment opportunities, let's say in equity markets, was restricted to a few thousand equities rather than something like 40,000 equities today. So looking at how these indices are built, we're speaking about the market capitalization indices. We do a variety of different types of indices, either market capitalization, which I'll come back to. We do ESG indices. We do what we call factor indices, which are either momentum or volatility or growth or value. And then we're increasingly doing thematic indices about mega trends in the world. When you look at the market capitalization indices, which is the lion's share of the indices that we create and the lion's share of the money that you were referring to that is benchmarked to MSCI indices, they're built globally. There are 84 countries or so that we follow. There are close to 50 countries that are classified in developed and emerging market. There is a number of other ones that are classified in frontier markets. And what we try to do is try to represent the opportunity set of securities in the world that only has two filtering criteria. And one of them is accessibility of the shares, and the other one is investability of the shares. So by accessibility means not too long ago, the Saudi market was closed. No foreign investors outside of the Gulf could invest in Saudi securities. So they're inaccessible. So there is no sense of putting them in an index because they cannot be accessed by anybody. The second criteria is investability. There are reasons why a stock cannot be investable. Let's say the float of a company could be 99% owned by the government. So those shares are not investable. You cannot buy and sell them. Investability could be liquidity issues in a particular small stock and the like. So those are the only two filters that we use. So when China began to reform its capital markets, especially their equity markets, it became clear to us back in 2013 that these reforms could open up the door to be able to include certain amount of China A shares, domestic China shares into the indices because they were accessible, although not with a huge amount, but they were a little bit accessible, and they were investable. So the first step was in 2017, in which we put a small amount, 5% of the value of the large cap securities in China went into the indices. The other thing that I will say to conclude this picture is that created a lot of news around the world, quite a lot of widespread information that finally MSCI was putting China securities into its emerging market indices, when in fact the MSCI emerging market indexes already have had a long history of including China securities in it. And if we can put that chart, that would be helpful. Jamie, in the first page, which is, if you look at this chart, going back to 1996, you can see the weight of China securities of all types into the MSCI Emerging Market Index. So by the time we included the A shares, the percentage of China weight in the MSCI Emerging Market Index was already 30%, which is Chinese securities that were listed. When you look at the bottom chart, were listed in the U.S. Like Alibaba and other securities like that, and listed in Hong Kong, for sure, right? So you see the orange here at the bottom is all the securities that were representing Chinese companies listed in Hong Kong. Then the green is the ones traded in New York. And then eventually, with the inclusion of the A shares, the blue is the securities that were listed in the A share market of China.
And could you talk a little bit about the dynamics of this process? Is MSCI's role to push investors to look at new opportunities, like to push them to pay more attention to China? Or is MSCI more in the position of responding to what your clients are asking you for?
That's a great question, Andy, because traditionally, up until, let's say, a year or two before the financial crisis, MSCI took a completely passive approach to including countries in our indices. The countries will approach us and say they will want to be part of our indices. We directed them to our website, to our methodology, to our criteria, and say, once you fulfill all of that, we will look at your country and we will include it. And that was it. No significant engagement or anything like that. That began to change with Korea. Korea, who was classified as an emerging market, wanted to be a developed market, and they started coming to us and visit us and ask us what they needed to do to achieve that. So we spent a lot of time with Korea in the 2007, 2008 period, sort of helping them think through all the things that they needed, to do, and they never actually did them. So that's why Korea in our index is still an emerging market. They didn't want to relax the trading of the won outside of Korea. They didn't want to make the data available for all sorts of investments around the world, and so on and so forth. The other country that was a little bit like that was Saudi Arabia. Saudi Arabia came to us and say, can you help us comply with the rules that you have, and help us direct us to the institutional investors so we can go explain how our country can be part of the indices. So we played a large role there, and similarly in China we played what I would call an honest broker role, so to speak, in which we went to our institutional investor clients, going back to the methodology that we have, asked them how do they view the conditions on the ground in China about investing in the A-share market and what needed to change. We then went to the regulators and said, if you want those investors to come to your country to invest, you gotta meet their needs. You gotta meet what they're looking for. You're a sovereign state. You can decide not to do anything, but if you want to do that, and they say, yes, we'd like to do that. So that we were going back and forth with that exchange of information. We actually invited a number of large institutional investors to meet with the regulators in China directly without us are intermediating the process, so they could hear directly what were the things that and the variables that these investors wanted to see in the evolution of the reforms in China for being to be part of the MSCI indices.
So did MSCI require China to actually meet those requirements before being put into the index, or was this part of a process where they get into the index but they agree over time to implement more of those reforms?
No, everything we do has to be very largely in some cases exclusively driven by reforms that have already taken place, and that are already in practice. Now, that's another good question, Andy, because obviously we do not want to promote a country into our indices knowing that a year or 2 years from now or 5 years from now, we're going to have to reverse that decision. So that was an interesting case in the example of Argentina, which we had announced that Argentina was going to go into the index, and then a year later, the circumstances were pretty bad, in the country with the election and everything, and we decided to still proceed and include Argentina, but we included only the ADRs rather than the domestic shares, which were more restricted by capital flows at the time. But that was an example of something that we were monitoring as to the progression. Are we going to make a decision to include the country and then reverse it? So we always look at that. But in direct answer to your question, everything has to be already done and already in practice, to meet the criteria for that particular inclusion. And then if a country wants a higher weight, then we have to work towards that with actual facts, right?
And from your conversations with Chinese regulators, what do you think was their primary motivation for making the changes that you and your clients were asking them to do? Because, a lot of people argue that China makes a lot of commitments on these things, but they're not really interested in following through. But in your case, they seem to have followed through. Is it because they just want the money from foreigners, or is it another reason? Some people suggest they want to make these changes to create a better capital market for their own domestic investors. How do you see that?
Yeah. So first of all, I during this whole period and even before that, we never met anybody in a senior government position in economics or in finance or in investment that did not want to reform and open up the capital markets of China. Maybe there were people like that, but we never met them. So everyone that we met was always interested in reform and in opening up. And the question was much more of what they needed to do to open up and the pace of that reform. And like everything in China, stability is something that is of paramount importance to the country. And therefore, capital market stability was very important, that they did not want to open up in a way that it will create a lot of commotion, in the financial markets and the like. So, secondly, they had, there was a big educational process, in introducing them to the investors and what was important to the investors versus what they thought was important. And they started a process of working through, step by steps, a lot of that. The other thing is that most people think of China as a monolithic country. It is made up of a lot of different interests, a lot of governmental agencies, a lot of regulation, regulatory agencies and all of that, in which they need to coordinate all these activities. So therefore, this is where, yes, sometimes they tell you they want to do something and then it gets stuck in that interagency or intergovernmental process of and it takes time. And therefore, in our case, another, investors' case, is well, they're not fulfilling their commitments or whatever. But it's not an intentional thing. It's just that they need to build the buy-in. They need to get, a lot of different approvals, and the like, to get there. So that has slowed down the process, many times, in what they're looking to do. But they were, a lot of the discussions that we always have had with them, they're very astute at trying to learn what investors want to do. And that now, what is the reason why they want to do that? I think it's part of the reform, modernization of China, is part of the integration of China to the global economy, in the global markets, the global family of countries and the like. So they put a lot of interest in that. They also, as you know, have a very retail-oriented market. They're building up their domestic institutional investors, but it's going to take some time to do that. So they felt that by bringing institutional investors from the outside, that was probably going to accelerate the process of institutionalizing the market. Clearly, they export capital and savings in a big way, and this will be an import of savings, right? Import of capital. It wasn't the driver factor, that they needed the money or anything like that. It was more like, how do we balance out the export of capital and the import of capital in a way that get us integrated into the global, financial markets. So, like anything in China, it takes time. What I normally describe is, in a lot of countries, you take 2 steps forward and 1 back, 2 forward and 1 back. In China, it's more like you take 2 steps forward and then you pause. And sometimes the pause is short, sometimes the pause is long. And then they take 2 steps forward and then they pause again. But we haven't seen much of a step back throughout this period of working with the investors and the regulators to try to find a way to do that. The last point that I will say is, MSCI is very careful to say 2 things. One is not really our decision. Most people think it's our decision to include a country or not include a country. It is a methodology that has been developed in consultation with global institutional investors, so that they have agreed to, that they think it works for them. And therefore, in a country fulfilling that methodology, they basically are fulfilling the wishes of investors, not the wishes of MSCI, but the wishes of investors. The second point that we always make is that these are all sovereign entities, sovereign countries. They have a choice, and the choice is, do they want to meet the needs? And notice, I don't say requirements or demands of investors. They either want to meet the needs of investors and attract them to come to the country, or they don't. That's a sovereign decision. That's a choice that they have. If they don't, it's perfectly fine. But if they do want to meet those needs, these are not demands, these are not requirements, these are not threats or anything like that. These are needs that, if you meet them on a voluntary basis, investors are going to come and invest in your country.
Okay, thanks, Henry. So a couple of minutes ago, you described China as a place with a lot of competing interests, competing power centers, competing agencies. Let's talk about another country that's important to MSCI that has a similar set of background, the United States. Last June, Senator Marco Rubio wrote a letter to you to express concern about A-share inclusion. This year, the White House has successfully lobbied the board that oversees the pension fund for federal employees not to give them the freedom to invest in a plan that would be based on one of your indices because it includes Chinese companies. The State Department recently urged university endowments not to invest in Chinese companies, including through your indices. State pension plans are under pressure from their governments. How do you, in general, respond to watching the kind of politics get involved in how different investors manage their fiduciary responsibility on behalf of their investors?
Well, we definitely monitor all sorts of developments around the world, but we pride ourselves strongly on being apolitical, an apolitical organization, and therefore we don't we operate in 90 countries, around the world. We have clients. We have 8,000 investment institutional clients in 90 countries. Many of the vast majority of the clients in those countries are benchmarked to MSCI indices from their country's perspective. If there is a law in that country that says they cannot invest in this or they cannot invest in that, or if there is an issue like sanctions, in the case of Russia, we cannot include a security that is sanctioned by the West and by America, for indices that are used by American institutions or European institutions, because that will be a violation of law in Western Europe and in the US. So we follow that, obviously very closely. For example, But besides that, we obey. Our methodology obeys to the needs of global institutional investors and global investors around the world in what they want to invest in, and the only two filters are accessibility and investability. We don't filter out whether a company is in defense, working for the country. So we don't go to France and say, is this company selling weapons on behalf of the French government to the Iranians? That's not our role, to do that. We don't come to the U.S. and say, is there a defense company that is working in partnership with the U.S. the Department of Defense to sell weapons around the world? That is not what we do, and we don't do that in China either, right? That's not our role. Our role is to look at the available number of securities that exist in a country, and then to do that. Now, so a lot of the pressure that has come to MSCI has been pressure to take a political perspective, to take a perspective that no, we're not going to include a particular company because it is associated with the Chinese government, or in other cases is associated with the French government or the the Russian government, right? Or associated with the American government or the Canadian government. That's not what we do. We stay neutral. We stay apolitical. Our role is to help facilitate the flow of investments around the world, complying with every single rule, every single law, every single regulation. So up until the time that somebody in America says that it is illegal to invest in Chinese companies, for American investors, we're going to have an index for, those investors. The other thing is that it's important to recognize is that we don't force anybody to be benchmarked to MSCI. They have a choice. And sometimes many institutional investors come to us and say, can you build me an index that excludes the following companies or the following countries or the following, type of securities and the like. And that's what we do. We help them sort of build those indices so that those become the benchmark for their portfolio. So to us, what we do is pretty clear, is apolitical. We don't take sides. We comply with all laws. Our methodology, it goes through extensive consultations. Every change that we make goes to 300-400 consultations around the world to make sure that is open, it's transparent. We do public releases of them. We put them on our website for public comment for long periods of time, and all of that. So we stand behind that methodology to whoever wants to attack it.
Okay, let's bring Hong Kong into the picture now, and I want to start with maybe the hottest issue at the moment in terms of U.S. Hong Kong investment relations, and that's the absence of an agreement between China's regulators and the U.S. Public Company Accounting Oversight Board, the PCAOB, which is required under U.S. law, under Sarbanes-Oxley, to audit the workbooks of accounting firms which audit the companies that are listed in New York, regardless of where they are, including Chinese companies and Hong Kong companies. And this has been a sticking point. There is discussion about forcing some Chinese companies that are listed in the United States to delist, theoretically, potentially to move back to Hong Kong. Now, you've got contacts in both regulatory camps, in actually all three, in Hong Kong, in Beijing, and Washington. Have you talked to regulators in these places about trying to resolve this issue?
No, we haven't, for the good reason that Andy, that our methodology to create indices is about where the country, where the company originates its business. So, our MSCI China index includes companies that are listed in the US, that are listed in Hong Kong, that are listed obviously inside China, but they could be listed in London, they could be listed in Frankfurt, they could be listed in Singapore. So we ourselves are relatively indifferent on where the primary listing of the company is. because what we're looking for is an exposure of the of where the company is doing business, right? So in this case, China. So therefore, we don't have anything to gain or be part of this debate as to whether they're listing or not. Now, if they're passing laws and regulations that are going to eventually reduce or maybe eliminate the companies that are listed in the NYSE and NASDAQ, then and let's say those companies move their primary listing to Hong Kong, it's not going to have any effect on our indices. It may have implications about the business that the two exchanges do. It may have implications about retail investors having access or not having access to that, but institutional investors are going to buy these shares anywhere in the world. Institutional investors today buy shares all over the world, whether they buy them in New York or they buy them in Hong Kong.
So if a large Chinese company that's in your indexes, which is now listed in New York, I won't use names for compliance reasons, was to be forcibly delist, kicked out of the US market because of this dispute over the auditing of workbooks, that doesn't have an impact on your business and your clients? Would you just, if they change their primary listing to Hong Kong, everything would stay the same in your indexes?
Largely. The only thing that will change is that the prices that we pick for the calculation of the index, go, and the closing prices, for example, for the end of day calculation, moves from the New York Stock Exchange or NASDAQ to Hong Kong. That's is a mechanical change that we need to make. But besides that, there is no change.
Do you worry that if there was widespread delisting of Chinese companies, which would then potentially create an atmosphere where foreign companies would feel unwelcome in the United States? For example, I have a friend who's in the private equity business in China who told me recently that he's got half a dozen Chinese companies that are looking to do an IPO in the coming few quarters. And he said a year ago, at least half of them would have wanted to list in New York. Now, none of them are looking at New York. This has the potential to really weaken US capital markets. Doesn't that have an impact on your business? Doesn't that want to make you kind of use your contacts to get in there and knock heads together to solve this problem?
As it relates to I may have my own personal opinion that that's not a good development for the country that I live in, which is America, and the capital formation, capital raising, capital trading that happens in America, and especially as an immigrant that came to America from a communist country, right? I would like to see America prosper as the leader of the free markets in the world, as the leader of capitalism in the world, as the leader of the capital markets in the world. And obviously, I would feel that may not be a good development. But as it relates to the business of MSCI, it has no implications. Capital for us is, if anything, if you think about, and Jamie, maybe we can put that slide and go to the last page. But the market in Hong Kong for IPOs is booming, and it has been for quite some time. If you look at this page, at the top is the IPO proceeds from 17 to 19 in the four big exchanges in the world. The Hong Kong exchanges, New York NYSE, NASDAQ, and the London Stock Exchange. By proceeds. And in the bottom part is by the number of IPOs. And you see that Hong Kong has already exceeded London. And it's already getting very close. It's already actually exceeded New York and NASDAQ this year, 2020, which is not included here. But it's obviously an abnormal year because of the pandemic here in the US. And for sure, in the number of IPOs, you can see that. Hong Kong is also, and I'm sure we're going to get into that, but Hong Kong is one of there's only two places in the world where you can list these tremendously high multiple securities in the world, in which they may not have a lot of revenue, they may not have a lot of profits, and they trade at enormous valuations. And that is New York and Hong Kong. You cannot achieve that in Frankfurt, you cannot achieve that in London, or pretty much anywhere in the world. So Hong Kong is already developing into a very large market for high growth companies with significant valuations, which was only the purview of the U.S. capital markets, for many decades. That's already changing. So all of that is the role of Hong Kong is becoming more important from that perspective, and therefore, again, for MSCI and MSCI institutional clients, these are people that, with their managers, by institutional investors, I mean the asset owners, the pension fund, the sovereign wealth funds, and their managers, and the managers have their global broker dealers and global investment banks. They can execute transactions anywhere in the world. They do that today. If you go back to the 12 or so trillion dollars of assets, that is all over the world, and that is already invested by institutional investors through managers and executed through global broker dealers, and those are securities that are bought everywhere in the world. So therefore, from that perspective, all these entities can buy and sell securities anywhere in the world. So if you exclude or pass laws that they cannot do it in the New York Stock Exchange, they're going to buy them in Hong Kong. Now, if you pass a law that American institutions cannot buy Chinese companies at all, they obviously they won't be able to buy them in New York or Hong Kong, for that matter.
So we've talked about the flow of capital. Let's talk about the flow of people for a minute, because you're now running a pretty large organization. When you're looking to recruit people who are not Americans, and they have an option of working in those two big markets you described of Hong Kong or New York, do you feel that bright people starting out their careers still want to come to New York? Would they rather go to Hong Kong these days? Do they still want to go to Hong Kong, given what's been happening in the political side there?
Well, we're a little bit special at MSCI. We have 3,500 professionals in 22 countries, and we are, we of the 3,500, about 700 and change are in the U.S. So the majority of our employee base is spread in all over the world, particularly the big financial centers around the world. So we can provide opportunities to somebody that, let's say, is mainland Chinese or a Hong Kong person that wants to live close to their family, their food, their practices, their habits. We provide enormous opportunities for them to work directly there, rather than expatriate themselves to go to Frankfurt, New York, or London. So we're very unique, from that perspective. But I think what is also happening is that the capital markets of the world are democratizing. They're spreading, to a variety of different places in the world. We mentioned Hong Kong and New York. Obviously, you got Singapore, you got Tokyo, you got London, you got Frankfurt. So in the old days, beyond World War II, and sort of the first 30 to 50 years or so after World War II, it was largely concentrated in America, because that was the only place that you could do that. The rest of the world was either devastated and being rebuilt, or it was still in development. Now you can find very strong development all over the world. So the bad part is that obviously we would like talent to be more fungible. We would like to have people that are in Mumbai or in India and come to New York, and relocate people from New York to Tokyo or from New York to Hong Kong and all of that. And that is becoming much more difficult, because every country is now putting a significant number of barriers to the flow of talent in the world. They initially wanted to do that with the flow of low-skilled labor, right? But they cannot apply laws to only low-skilled labor. They have to apply it across the board, and a lot of the top-end talent has been restricted from that. So I think what we have now is the world started with a trade war. Let me back up. There are three things that two countries can do, right, with one another peacefully. One is they can exchange goods, and services. The other thing is that they can exchange population at some level, or three, they can exchange savings. So, the problem started with trade restrictions, then it moved to people restrictions, and as I said, before in prior forum, is now moving to savings restrictions, so capital restrictions, and potentially becoming capital wars. So it's a trend that is going on in the world, which is worrisome, including what you asked, which is the more freer flow of talent around the world, which will benefit society immensely if it were to continue. But every country is trying to be, mercantilistic and defensive about it.
Okay, so while we talk about the free flow of capital and ideas, let's focus in a little bit more on Hong Kong. The new national security law that's been in place for a couple of months now doesn't directly address the financial sector, but it's very broad as well as not very well defined right now. Based on what you know so far, what do you feel is going to be the impact on Hong Kong's ability to continue to be Asia's financial center with the national security law, the way it's being interpreted and implemented today?
So there have been two sources of competitive advantage for Hong Kong to be a global financial center. Not in this order, but one is the ability of Hong Kong to be completely free and unrestrained in what they write, what they say, and the like, including what they say about China. The second one is the ability of Hong Kong to be the gateway of investments into China, going into China and coming out of China. So I think the role of Hong Kong as a financial center has been a direct result of both of those trends. So what you're going to see happening now, in my humble opinion, is that there is definitely restrictions as to the expression or the free expression, particularly matters having to do with China, because of the national security law. So that's going to put a dampen in Hong Kong as a financial center. The flip side of that, is going to be that the restrictions that have existed in China being an intermediary of capital between the West and the rest of the world and Hong Kong is going to come down. Hong Kong will become more and more one of the major financial centers for capital inflows and capital outflows of China. And therefore, the calculus that needs to be weighed for those that say it's the end of Hong Kong is, whether or not the lowering of the free expression, as it relates to China, is going to be, smaller or bigger than the role of Hong Kong in being the intermediary of capital going in and out of China. My calculus, based on what I've seen and decisions that we have made, particularly about our derivative business, is that the second part is gonna more than offset the first part. I'm not condoning, or I'm not having an opinion one way or another here, a political opinion as to expression. I'm just saying that if you look at the facts, Hong Kong will continue to be a major financial center of the world as long as China continues to develop, continues to have access to the capital markets through Hong Kong, continues to be the second largest and eventually the first largest economy in the world, continues to expand its financial markets and the like. So, unless there are laws all over the world that will prevent investors from going into China, investors that are free to make decisions cannot afford to miss the growth and investment opportunities in China, and they're going to do that through Hong Kong. because they're not going to do that at this moment through Shanghai directly or Shenzhen directly. The conditions are not there yet. They're going to do that through Hong Kong. And therefore, I think Hong Kong will continue to thrive as a major financial center for years, maybe decades to come.
Are you concerned that the changes to the legal structure in Hong Kong mean that it's gradually becoming more like Shanghai, and really there is no longer a competitive advantage in a number of aspects for Hong Kong, and that this will lead to Hong Kong being less attractive to foreign investors compared to Shanghai?
Not really as it relates to sort of financial transactions, right? There's no question that as it relates to criticisms, right? Of China, the law is going to be very onerous to those people that do that in China, and that may involve, if you want to write a research report that is critical of China, that as somebody who's run those kinds of operations, right? But as it relates to the laws for settlement of trades, disputes between one party and another on financial transactions and the like, I think that Hong Kong will preserve its rule of law for a significant period of time. I can't predict, what's going to happen 20 years from now, but for at least the foreseeable future, I don't anticipate any of that being, watered down. So an example of that is the reappointment of Ashley Adler as the head of the SFC, the Securities and Futures Commission. They could have appointed more of a Chinese national, for example, but they decided to continue to have a Westerner that's lived in the country or in the SAR, right, for a long period of time to govern, how the securities laws are being applied, in the country. So that's an example of that. So I don't see that happening, at least not in what we see today. But again, I'm not saying that I'm welcoming or rejoicing about the national security law as it applies to the freedom of expression of people in what they do. I'm strictly trying to be what I would call a scientist, as it relates to, the capital markets and financial transactions and financial flows.
Okay, those are good points. Thank you. And MSCI has increasingly, I guess over the last decade or so, put more emphasis on the ESG part of your business, the environment, governance, social responsibility part. And I know that that's a big part of the business and a part that people really look to MSCI as a leader for. To what extent do these issues that we've been talking about in Hong Kong then come into play when you think about markets where you want to be active and expanding? If there is a less strong rule of law when it comes to financial issues, if there is censorship or even a chilling effect on the ability of analysts and economists to write about Chinese economic policy or state-owned companies, will that have an impact on the way MSCI views its business and the way it constructs its indexes with respect to Hong Kong and Chinese companies listed in Hong Kong?
Well, it will with respect to our ESG indices. Going back to the division, we have market cap indices that are there to measure the opportunity set with only two filters, which is accessibility and investability. And then we have ESG indices, and obviously we have climate change indices, but the ESG indices that do filter for the rule of law in a country, that do filter for the social issues, in terms of treatment of minorities and treatment of women in the labor markets, and whether you have a hostile working environment or a friendly working environment, and obviously governance issues in a company with respect to who is actually running the company. If it's a public company, but it's dictated, a lot of its policy and strategy is dictated by not the shareholders, but a third party, then that has an effect on that. And therefore, we definitely are going to be very outspoken, about those issues. We have a family of ESG indices that are composed, according to those ratings. We're the largest ESG rating agency in the world. Both equity and bonds. We obviously rate ESG. We have ESG ratings for sovereign bonds around the world. So that means we are rating the environmental policies, the governance policies, and the social policies of the state, through the sovereign bonds. So that's definitely going to have an impact. With respect to China and ESG, we actually have been welcomed by regulators, in China with our ESG ratings and our ESG indices, and they want us to write more about it and the like, because they are also looking to improve the performance of a lot of these companies, and it's very hard for the state to be policing, every company as to what they do or don't do on these matters. And they like that there is the role of the private sector as a watchdog for these issues, and putting pressure on companies and using investors and the allocation of capital, to do this. So that has been a very welcome development, for us.
Does that create a similar role for you in Hong Kong? Because yes. I'm guessing that some of the global banks, brokerage firms are a little bit reluctant to speak their mind to the leaders of Hong Kong or the people in Beijing who work on Hong Kong about what's happening there. Are you in a unique position, given MSCI's role, your experience in the industry and the region, to sit down with leaders in both Hong Kong and Beijing and talk to them about what you're hearing from the industry and what they need to be concerned about in terms of the direction of where things are going, in terms of preserving Hong Kong as a global financial center?
We definitely are equipped to do that. We haven't started that process, talking to the Hong Kong authorities or the leadership there, about those issues, because so far, the question then becomes is, remember, we're involved in the investment industry. So the question becomes, if Hong Kong has restrictions on the free expression as it relates to China, how does that impact an investment? So you have to have a direct impact on a particular company's and its investment, right? The investment in that company. So we for sure are going to be doing that. We are, at a company largely owned by shareholders. 97% of our 96+% of our shareholders are public shareholders in the New York Stock Exchange. The balance is owned by me and the management team in the company. We are, so we're not beholden to the ownership by anybody or an exchange or a media company or anybody who's going to either have an agenda or put a restriction on us. Secondly, we are very independent. We serve the needs of our clients, which are the global investors of the world. We don't have a conflict of interest between the issuers and the clients. We get paid by the investors, not by the issuers in a lot of these ratings. We are outspoken in our views, but as it relates to what is material to an investment, we're not trying to be zealous. We try to be scientific about the approach that we take. We try not to take sides, but we try to be data-based, fact-based, and scientific in the way we create these ratings. For example, so we have a large role to play, and most countries, they want us there because a lot of the people in the country, in general, want to improve, what they do. Now, I'm sure that there will be a rating of a company in which the head of that company is very friendly with the head of the state of that company, and they're gonna come and go upset or something, and we say, so what? You can be upset, but this is the rating. This is the way we approach every other company in the world. So that's not gonna it's not gonna stop us, from doing that. But again, the important part is that we're not zealots. We're not trying to be, editorial in nature, take sides. We're trying to follow a methodology that is public, a scientific approach, a fact-based approach, a database approach. We don't want to make exceptions. We apply it across the board to anything, every single company everywhere in the world. And we're going to be doing the same thing in Hong Kong and China.
Great. Thank you, Henry. So I'm going to switch around a little bit. Don't go away, Henry. And our audience, hold on, and we're going to get to your questions that Henry will answer. But first, I want to pass the microphone back to Margaret Connolly, Executive Director of the Asia Society.
Andy, thank you very much. We wanted to jump in here live because we have an opportunity to hear from a special guest, Jack Wadsworth. He is our honorary chair at Northern California Asia Society. He's also honorary chair of Morgan Stanley Asia. This program was Jack's idea. He helped us secure Henry, so we're very grateful to him for that. Jack is also an advisory director of Morgan Stanley. He lived in Japan as head of their office there in 1987, and then 5 years later, he moved to Hong Kong, where he was chair of Morgan Stanley Asia. So Jack, a few words, please.
Margaret, thank you so much. And Henry and Andy, I really appreciate your comments and the light that you have shed on this whole question of what I think is the central question for this conversation. You can't separate Hong Kong from China, or for that matter, Hong Kong from the world, but the competitiveness of the Hong Kong financial markets going forward has become a major global debate because of the new securities law. And I think that your conversation at least has persuaded me that the right answer to that question is time will tell. I mean, these things don't change overnight. Great financial markets have large market caps, large volumes, great companies listed. And probably the most important issue is the talent, that is attracted to these financial markets, because the intermediaries and the investors, all of whom populate a place like Hong Kong, have to find it to be a friendly, accommodating place. And as both Henry and Andy said, I mean, this whole question of freedom of expression is something that doesn't change overnight, and we'll have to see. And the rule of law and regulation, there have to be test cases, and we will see. But as the head of Morgan Stanley in Asia and living in Hong Kong for 10 years, a couple of observations. One, Hong Kong does not get enough credit for being the engine that drove the economic growth of China. I used to say there's never been a developing country the size of China with a fully well-regulated, efficient capital market lying within its borders. So in the early days, China benefited from foreign direct investment, but once securities began to be an important source of funding, and it was the privatization of China that really led to almost all the government-owned companies becoming public, the inflows of capital through the issuance of securities into the world capital market, added $50 billion a year to the inflows of capital into China. And that was a very crucial period. And so the question in my mind, and I always used to say that, there's the New York market, the Hong Kong market, and eventually Shanghai. Those are going to be the markets that dominate. And for reasons that have been mentioned, places like London and Frankfurt and Tokyo have never really emerged as a major, contributor of capital market activity. To me, these questions that have been raised by the new securities law really pale into insignificance when you think about what will the financial markets of China and Hong Kong look like when the renminbi is convertible on capital account and free flows of capital will be uninhibited between the world, and Chinese listed companies and investment opportunities. And I don't want to pose that as a question because it's all in the speculation of when will it happen. But that is going to be the game changer that makes the financial markets a different place. And I come away from your conversation with a feeling many of these trends are going to make Hong Kong an even more important financial market in the future than it is today. So I'd love to hear, Margaret, the questions that our audience has after what I think is a very rich conversation about the practical future of Hong Kong.
Thanks again, Jack, and Andy, all yours.
Okay, thanks, Jack and Margaret. So let's now go to some of the questions that have been raised by our audience, and I'm going to combine a few of them. So Henry, the first questions that I'm going to combine are about whether or not China has been given kind of a pass on some of the normal requirements to get inclusion in your indexes. For example, one person writes, isn't convertible currency a minimum requirement, yet the renminbi is not fully convertible? Somebody else has asked about the audit issue that we talked about before with PCAOB. If China is not willing to allow its companies to comply with the law in the United States requiring PCAOB audits of the workbooks, doesn't that disqualify them from being included in your indices?
The answer to the last part is that it doesn't, because we don't filter for, a third party, audit of the auditors, as an example, right? So that's not a filter that we use in the creation of, our indices. Actually, what has happened with the promotion, the evolution of China A shares in the MSCI indices has been actually the opposite of what the question implies. When we first launched the consultation to include China A shares, I think it was in 2013 or so, right around that time. I thought that because China was big, China had a lot of significant investment opportunities, a lot of potential for diversification in investors' portfolios, that we were going to have a tough time keeping in check our investor clients on the methodology, because I thought that maybe they were going to, in our consultations, they were going to encourage us, to be more lenient. It was the complete opposite. What happened? What happened was that the investors said, China is big. China is, it could be a major market. We want to invest in there, and therefore investors wanted us to raise the bar as compared to our methodology, on China. And the most frequently, mentioned feedback was, make it tough for these people to get into the index. That was a little bit of that. And of course, we don't do that. We keep an even keel, because we cannot be moving the methodology around, to just accommodate to the wishes of people, right? We have to have one methodology and apply it across time and across all countries. So that's what happened. And therefore, if you think about the first inclusion of 5%, it should have never been 5%. 5% was a minuscule, very minuscule amount. So, the media at the time, the smart media said, this is about, huge announcement for extremely little money here, a small weight in the MSCI Emerging Market Index. So it was, I think, 70 basis points. The A-share market was 70 basis points of the MSCI Emerging Market Index, less than 1%, right? And therefore, why are we getting so crazy about that? The reason why we did that small inclusion was because there was too much friction. There was too much, too much debate, too much, spirits, too much emotion going around. So we said, why don't we put a small inclusion? Everyone gets to know one another. So the investors get to experience what it is to invest in China. The regulators get to experience what it is to deal with these investors, and then we figure out what is next. So to the surprise of many, a year plus later, we announced that we were going to move the 5% to 20% because and it was overwhelming support in our consultation by investors to do that. When in the first one, it was strong support, was majority support, but there was a lot of skeptics in the minority, right?
But it's still only 20%. So one of our other listeners has just jumped in on the Q&A spot and said, when are we going to get to full inclusion? What's the holdup?
Oh no, there are a number of requirements, and we've been public about those requirements. There are 4 requirements that are technical in nature, but very, very important for the full inclusion into the MSCI. Remember, these are the MSCI emerging market indices, not the developed market indices. They have a higher bar. So the emerging market indices, the first one is the settlement system. You cannot be, is extremely disruptive to be pre-funding trades because you gotta settle T+0 or T+1. So that's not gonna fly, with investors around the world. The second one is the ability for investors to pull trades together in what is called an omnibus account. It's like, think of it as a bus. You gotta put all the trades together. It's extremely, disruptive to be doing every single trade and settlement. It kind of grinds the investment process to a halt. The third one is this issue of the holidays between Hong Kong and China. The marketing for investors through Hong Kong, through Connect, is not only closed when there is a holiday in China, in Hong Kong, and China is open, but it's also closed the day before. So therefore, if something were to happen in China during that 2-day period, you own private equities. You don't own public equities. You cannot get out. And the fourth one is the restrictions that in the past China has placed on the availability of its data, of the data of the exchanges for the creation of financial products, whether it's futures, options, structured products, and the like. Even the emerging markets don't put those restrictions. So those are the things that need to be worked on before we move any further.
So can you, based on your conversations with regulators out there, give us a forecast of when you think we might get to full inclusion?
No, full inclusion is a long way away. The only question becomes is what is the next inclusion? The next percentage, whatever percentage increase, and we'll have to see. Going back to the first comment you asked, the first question is we'll have to see significant changes to these 4 criteria before we do that. We know that the government authorities in China are working on them, but there is no yet tangible evidence of putting any of that in practice. Right?
So does that indicate to you that in the current climate in China, there's less of an appetite for moving ahead with the reform and opening processes?
No. I initially thought 2-3 years ago that the speed of change would accelerate, and it didn't. It just kept going at the same pace. So all the things are being worked on. There are discussions, there are debates, and all of that. So the speed of change is either the same or a little bit slower than before, but it hasn't stopped. There's no that I can see policy to not be part of the global financial markets or anything like that. It's just that the country is dealing with so many variables, and there are only so many. This requires approval by a lot of senior people, and a lot of those senior people are focused on a lot of other things that are going on in the world.
Okay. So I have another question where the audience member is drawing on some of your earlier comments and some of Jack's comments, where it seems like we're saying that as investors, we need to focus on our business and not get political. But does that abdicate a role that we should have as investors who are responsible for the supervising the flow of capital around the world and We have a fiduciary responsibility for the people who are entrusting that money to us. Should we be speaking up more? Should we be speaking up more in Washington, in Beijing, in Hong Kong about a lot of the issues we had here, as opposed to just keeping our head down and focusing on our business? And as a, an advocate for ESG, how do you see that as well?
Well, I said that MSCI is apolitical. MSCI, doesn't want to sort of drive the process of that. I fully expect our clients, the global investors, to make decisions about overweight of countries or underweight of countries, overweight of securities and underweight of securities, based on partly on political implications that will have a material effect on the investment in those securities. So, for example, if I know that a Chinese company is going to be put on a sanction list in the U.S. or in Europe, it will make no sense for me as an investor to put a large position in that company until I know the implications of that, because there's going to be less demand and there's going to be a lot of selling pressure on that security, as an example. So I think that there is a role to be played by investors. And a lot of investors have been playing that role. Obviously, for example, in climate change, investors have been extremely vocal with the oil and gas companies about their role in the transformation of the energy industry in the world, and they have been selling those securities. So oil and gas companies obviously have declined in value significantly because of oil prices, but they also have declined in value significantly because there is less demand by investors that are following climate change portfolios or fossil fuel free portfolios and the like. So I think there is a big role to play, and the other part is that unless the private sector, unless investors play that role, it will have to be played by political entities. And that's I'm not sure that the investment industry will want to see that happen, because it has significantly other negative implications about the relationships between states and the like. It's better for the private sector to be putting this pressure on countries and capital markets and governments to reform their companies.
Okay. And we also have a question from the audience about your reference earlier to consultation with your clients about how to go ahead with things like A-share inclusion. And the audience member is writing in and saying, I think he feels kind of left out of the consultation process. He's saying, didn't MSCI just focus on sovereign wealth funds and really big asset managers? But what about the retail guy? Didn't he get to have a voice in how you went ahead, for example, with A-share inclusion?
No, what we do is a two-step process. It's a two-pronged process. One is we publish the consultation paper that typically has a proposal of how we're going to deal with that particular country. We put it on our website. We put press releases announcing that we are seeking public comments about this. We encourage people to write to us. It will be completely ineffective for us to go out and seek, individual investors' view, one at a time. So we put a public release, expressing that, if anybody has any comment about this, they should write to us. And some people, a lot of people write to us, directly about this. And then on top of that, we do a consultation in all regions of the world. US, Canada, EMEA or Europe and Middle East and Asia we consult with asset owners, the pension funds, sovereign wealth funds. We consult with a lot of different asset managers, and we consult with broker dealers. And in some cases, we consult with custodians, when it has to do with the sort of the operations of the settlement system and the like. We try to be as exhaustive as possible to represent the views of that. Now, it is fair to say that MSCI caters to institutional investors because that's our client base. It is institutional investors who use the indices to benchmark investors and their managers. So somebody like Fidelity, they run retail funds, but Fidelity is an institutional entity, and we do consultations with them, or Janus or T. Rowe Price or somebody like that in the US, or DWS in Europe, et cetera, right? So we're trying to capture the individual investors through their mutual fund, management, in that. So we're extremely exhaustive about this process. So, I would strongly recommend that, for the person who wrote that letter to send those written comments about all these proposals.
That's great. Thank you, Henry. And I think you're going to get a lot of emails when you wake up tomorrow morning in New York from our listeners with more questions. And I want to apologize to those of you who submitted questions that I wasn't able to get to, because I'm afraid we're running out of time shortly. But first, I want to thank Henry Fernandez, Chairman and CEO of MSCI, for a really great and open conversation about some difficult issues. And then I want to pass it back to Margaret Connolly at the Asia Society.
Thank you again, Andy, Henry, and Jack. That was a terrific conversation. We're going to be following all of this closely, and we invite you to join us to speak again, hopefully in person. And as Andy said, we had a lot of really terrific engagement from the audience, which is very telling about your conversation. So thank you again. To our audience, please join our virtual programs. We've hosted over 200 of them globally since we started sheltering in place in Northern California. We're averaging one virtual program a week, and most of these are free for members, so please do join us. We have 3 more programs in this US-China Seeking Truth Through Facts series. The third one is on intellectual property, and that's going to be on October 8th. Our 4th program is on semiconductors. That's on November 2nd. And this is all leading up to our 3rd annual Future of US-China Conference. That's going to be on January 14th. Please save the date for that. It is definitely going to be a big one. If you're interested in helping us develop any of these programs, or if you want to sponsor any of them, please do reach out to us as well. A big thank you to our team for their hard work on putting this program together. Rexel, Jamie, Polar, Michael, Heather, and all of our virtual interns, and from all of us at the Northern California Center, thank you and stay safe.